All right. Good morning, everybody. Job week continues. We get JOLTs today. Um, JOLTs is an easy one to remember. It's monitoring how easy it is to find another job if you lose your job. This is based on the concept, if you remember back in 07, 08, during the great financial crisis, jobs became more and more and more scarce. And if you had one, you really tried to keep it. Maybe tolerated things that you normally wouldn't tolerate because you're afraid that if you lost that job, it would be very hard to find another one. Jolts, an easy way to remember it, is take this job and shove it. The idea that you can leave your job and go find another one easily. So this whole week, we're going to continue to get job numbers in different formats, and job numbers is one of the Fed's windows to kind of get a feel for how their policy is interacting with the markets. Think of it as, the pulse of the economy, how well companies are doing. Are they hiring, laying people off? Are they having to? If you remember, for a while, companies were in a hiring crunch, and there was bonuses and sign-on, all sorts of perks that they were using to lure people away from their current job and bring them over to a company. So while the Fed says they're not trying to cause unemployment, they do want to see a slowing a little bit, right? They don't want a runaway market. And one of the easiest things that they can monitor is the unemployment levels. So we're still in the regime where bad news is good and good news is bad, from the concept that the Fed wants, the market wants to see the Fed cut. And if we continue to get good numbers, the Fed's not going to cut. That's the only thing that's going to make them cut, is as a response to such negative data that they feel a cut would protect the market or protect the economy. So if bad news is good and good news is bad, then things just get all sorts of out of whack. And that's where we've been now for quite a while. We saw it again yesterday. Looking at things that are going on around the world, uh, Japan is down the most at 1%. They did have that 10-year bond auction last night, and there was a discussion about reducing the number of bond purchases. And we did see the JGB 10-year reverse from that 1.1% level and is now closer to 1.0. Still need to get back below that level and continue to ease down back towards 0.9%, but one step at a time. Small caps down more than 0.75%, a bit of a whiplash from yesterday. S&P down more than a quarter, the Dow behind it, and the NASDAQ behind that, with Hong Kong basically flat. So this is Market Watch. We look at 3 different economic calendars, 4 if you think about Thinkorswim, because oftentimes I'll bring that one up too. And it may seem a little redundant at first if you haven't thought about this, but every one of these websites has a goal or an agenda, and looking at different ones presents us with a different picture. So this one, it's free. I'm not signed in. I don't have an account here. This is the week's major economic reports. It's not going to hit on every single report, and it's only for the US. That's a little bit blindsided, by the way. It's deliberately ignoring information out there, and it's only focusing on what it considers to be the biggest event, which is why a lot of times it won't have anything here at all. If this was the only thing we were using, we would be completely blind to everything that's happening around the world, and it just isn't good enough. But if you're trying to focus in on the biggest thing of the day. This is a nice, clean format. The ads aren't overwhelming. They're not popping up like crazy all over the place. It's clean. You can see exactly what the big thing is for the day. So not confusing, not overwhelming, but it's not everything. This is FX Street. Again, you don't need an account for this either. And you get the ability to set the time zone for the market. That way, if you live, say, anywhere else in the world and you find it confusing to keep track of market hours, at least this one, you can set it to market hours. And then the time frame that you see is for the time frame of the market. But you can also set it to your own time frame so that you'll know when in your time zone this particular event is going to happen. It does look at events from around the world and gives you an impact gauge. That's not always accurate, but it's giving you a historical perspective on how this particular economic data point has impacted the market in the past. So it's a bit of a heads up, kind of handy if you're not familiar with the different economic events. And it does look at things from around the world, which is really useful. That way we're not blindsided by, other countries having CPI, PPI, job numbers, because those situations can impact us. We do want to know what's going on. Today, you can see the biggest thing on the list, factory orders and job openings, which, funny enough, those two kind of go hand in hand anyways. We also have the Red Book at 9 o'clock. I'm not going to say that that one's not important, but a lot of times when we get the Red Book data, we really don't see a lot of movement in the market. And it does have it listed as a low impact. We're going to get some optimism numbers. This is the warm, fuzzy, feel-good numbers. Take that with a grain of salt. Then we have Finance Juice. This one also is free. You can open an account here for free, which I highly recommend you do, because this is a news aggregate site. It's going to get news from all over the place. And I don't know about you, but I don't really care what CNN and Fox News and MSNBC. I don't need that. I don't want it. It's just distracting trash, and I don't need it in my feed. If you open at least the free account, then you can turn those sources off and they won't be in your feed, which is really nice. This is not only going to show you the economic events for the day, but it also does a really good job with different Fed speakers, not just ours, but Fed speakers from around the world, like European central bankers. That's really important for a number of reasons, but one, sometimes their schedule is just made in a very short time and they didn't really get the word out to a lot of the other places. It will show up here. So if it's been on the calendar for a long time, sure, you might find it in other places, but this calendar seems to be more responsive to changes to the speaker schedule. Plus, it does have global bankers on the list. That way, if heads of state in another country are talking, they'll be in this list as well. It's also, as a news aggregate, going to pop up when those speakers are talking about something, especially if they say anything that may move the markets. This will do a really good job. It'll turn bright red. Oftentimes, it'll give you a chart of when the event was said and what the market did afterwards. It also has a pre-market summary, kind of a pre-market briefing, and an after-market summary for the Asian markets, European markets, and US markets. That's really handy when halfway through the day in our markets, say you see a big move, look around and you really just can't find a reason for the move. Come back here at the end of the day, check their after hours report and see if they have an explanation for why the market made a particular move. They don't always, by the way, but it's handy. Now, they're going to give you a European market wrap because they know that the US is coming online. We want to know what's going on with Europe, but Europe's not going to close for hours still. So, don't let that name fool you. It's not closed and it's not going to close for a couple hours, but they just do that for us. That's a really good way to get caught up on what happened in the overnight hours. It does have search features too, which is really nice, so that we knew that Japan had their 10-year auction last night. I could just search for Japan or the JGB 10-year and find the reports without having to scroll back trying to find it in all this mess. And it's got Tick Strike, which is an audio order flow tool. The free version will at least get your attention, but obviously the paid one's better. Still, it's better than nothing. I use that a lot when I'm writing or taking notes and I'm not watching the charts. I just turn that on, listen for changes in the order flow. So we have this halfback level 5260, basically. Tested it yesterday, held above it, tested 5300, failed to get above it or keep above it. And now we've tested this 5260 again. So that's kind of our zone. Now that we've got yesterday's range, we can also consider that a bit of a zone. So we got to get outside of yesterday's range. We got to get through our own Globex range. And for a downside move, we still have to get outside of Friday's range. But one step at a time. Right now, the main thing to focus on is our own Globex high. This zone right here, which has its own halfback. I was looking at what was down this morning, and banks are getting whacked pretty good. Wells Fargo, Bank of America, JP Morgan, all down around 0.75%. So here we've got a daily chart. We've got a point of control level at 5308. So if we continue that drive to the upside, we have to challenge yesterday's level. And that's a level where we've had some selling. We don't know if that selling is done yet. We have to anticipate there's still a lot of sellers around that cog line, that 5311 point of control. So you can kind of see the line in the sand right about 5300. I don't have it marked here, but 5300 is a significant line in the sand that we have to get through. We've been able to wick up through it, just not keep it. The major options level too, it's also a round number. It's a psychological number. That's what we have to get through. But if we do get through it, we still have that point of control to deal with. It's the greatest amount of volume from Sunday night into Monday and all through Monday into the end of the day. That's where the greatest amount of volume happened. So think about this doji that we have from yesterday. All of this doji with all of that length, and still the greatest amount of volume was right there up at the top, 5308.5. We've already cut through the ADR half. When we open every day in the Globex, we've got our ADR range, average daily range, and we could move up 0.88 or we could move down 0.88. But we could also split the difference. 0.44 in one direction, 0.44 in the other direction, and this distance from one side of the red line to the other would be 0.88. Well, we've already made the red line. Typically, if we get to the red line early enough in the day, we can go to the other side, go to the other red line. But we broke this red line and actually cut through it, which sets us into a completely different standard. Now we have to think about the fact that we can go and tag the full lower ADR, which we ended up building a base. We have a failed bear flag play. That owes us back up to, like 52, 89, 85, whatever this level is. Getting back above this ADR half isn't enough because we can sit here and chop at this level now for the rest of the day. That would be a very boring day, by the way, right? It wouldn't be all that exciting, but since we didn't hold on it to try to bounce and go to this other level, and instead we cut through it, we now can just have this zone, and this could be the rest of our day. There's a cog line at 52.92, so we'll call that the upper edge, and then we already have our lower edge here. I know that's not what I want. I'm sure it's not what a lot of you want, but just kind of be prepared for that because that's our setup at the moment. If we can get through this zone, that 52.92 as a high, then we can challenge this area here, get through 5,300, and then focus on getting to the next ADR level. All right, so in this continued move to the upside, 52.92, 5,300, then 53.23, and depending on how we negotiate that level, we can focus on 53.50. You can see it's really going to struggle at this zone. All right, so here's our pivot points. The channel today is within yesterday's channel. It's not completely outside of it. Like these two channels, they're not touching. These two channels are. These two channels were. It's not an overly narrow channel, so the expectation is for a range day, not for an expansion day. If you think about yesterday, how we closed ended up proving that point, but this really wide channel suggested yesterday would be a range day, not a trend day. We had one heck of a breakdown, but by the time it was all done, we dojied. So maybe a little misleading in the advertising, perhaps, but it still ended up being a range day. Plus, it was still inside of Friday's range, so it still counts as a range day. The only saving grace from yesterday is we had a really nice breakdown of that Globex range, an attempt at a Busby, and then the V play. So at least we had some really good setups. We got really close to the S1, close counts. We don't have to tag it to count it. The way pivots work with the S and R levels is on a pullback to an S level, we would expect like an S1 and then an R2 or an R1 and an S2. Right? If we go back historically, that's generally the way we want to play it out if we get the expansion, because it doesn't owe us the expansion. Right? We can see plenty of times where we get down to an S level, like S1, and we stay there. We never get above the pivot. We can take Friday for an example where we were tagging the S1 levels, made a run like we were going to try to hit the R2, stalled out on that, and still ended up hitting an S2 by the time it was done. It does matter where we open. We've got the Globex open, which is not really the open we want to focus on. It's the RTH open. So when we get into the RTH, we want to look at how price is going to open in relation to that pivot point. Take yesterday for an example, we were gapped up and we had not made it above the R1 level. That makes the pivot the magnet. And the expectation is that we're going to go to that magnet. We want to look at today and see what today has to offer as we get closer to the 9:30 open. If we're close to this pivot, we're very likely going to go to that pivot. Now, we've already been there. We've already hit it. That's different than yesterday. Yesterday, we had not yet hit it, and we weren't above the R level. So we came down to the pivot like a magnet. But we've already hit it today. that reduces its quote magnet properties, if you want to consider it that way. And it does a really good job of defining this range or this zone that we're in that we could chop around because of that ADR level. Got some real high volume today, sitting at around 150. It's not extreme volume, but that is a lot of volume considering the sort of volume we've been seeing lately. 70s, 80s, 90s, 146. It's been a while since we've had that level of volume in the overnight hours. Spot Gamma just released their AM edition founders note. And of course, I haven't had a time to look at it yet, but it does seem at a glance that they're talking about some 0-day flows from yesterday that kind of helped with that rally and laying out some key resistance levels. They've got a chart at the end of it, and I'll end up posting that PDF after I'm done with this Zoom. If you scroll down to the bottom of it after I post it, you'll see a chart on the daily time frame for the SPX, and they've got a range showing the high end 5,400 call wall, 5,300 resistance, 5,200 support, and then things just get really nasty below that. They're laying out things like the FOMC, which is upcoming, and some put levels. I'll let you guys read it when I post it, but for those who don't look, maybe today you want to take a look. So 0 gamma held. Right now, we've still got the volatility trigger overhead, and we have the weekly pivot point, 5282. Now, the weekly pivot point, we did interact with it yesterday. We interacted with it again in the Globex last night. 5280, that weekly pivot, it's more of a perspective than anything else. But when we're above it, we look for bullish opportunities. When we're below it, we look for bearish opportunities. But right now, just like yesterday, we're cutting back and forth through that level. So it doesn't have that sort of bias yet. We need to be above it or below it and actually keep it. Then we can start looking for, the bias that goes with that. Short below, long above. Yeah, there we triggered the elevated volumes now because we're at 150. So call wall now, 54.14. Rolling that call wall up is considered a bullish action, a bullish behavior, bullish bias. We don't have any major voodoo levels until 52.46. Would be this forest or that green line way down here. It's yesterday's low. Now, I don't want to say that yesterday's low was caused by this 52.46, but if you were looking at the dome and the order flow yesterday, there was a lot of orders front running that 52.46. We could say that maybe they were just running the 52.50, which makes sense. It's an options level. But I watch these voodoo lines all the time, always as a skeptic. Can't trust something that I don't understand. They don't tell us where these levels come from, and they're always they're hand-drawn levels, right? So that indicator isn't measuring anything. I know I read Thinkorswim code. I code Thinkorswim. We have to go download these levels from the website, and they're put in there by hand. So, I use them on the chart because they do provide a lot of context, but I never trade those levels. I always have to trade based on other information. I had plenty of information on that flip yesterday. even if we didn't have trust in the voodoo line. Profile is still just the D shape. A lot of volume continues to hold at that 53.20, 53.30 area. That 53.32 is a cog line. It's also the point of control for the TPO. So we got TPO in blue and a volume profile in green. I know these both look like volume profiles, but they're not. Throughout this week, we're going to continue to lose volume across this 53.32, 53.22 area. But if we run back up into that area, then we're going to be providing more volume there again. The profile isn't going to shrink anytime soon since we set this low. We would need, another 8 days before we finally get this low print taken off of the profile. And there's no reason to expect that we're going to set a lower low than this. But we've got a reasonably wide range, 5,200 to 53.68. That's our zone. But by the end of this week, if we don't make new highs, then we're going to lose another 20 points off the top, and that'll narrow our profile a little bit. No expectation of the point of control moving down unless we build more volume up at this level, around right under 5,300. And that's what we're looking for the new point of control, somewhere around that 52.92 cog line. We'll be looking for this point of control to move down. One, because we'll be continuing to add more volume at this level, but the other reason will be because we're going to lose more volume from this level. But really, if you see where the point of control is at 53.22, it's this volume we have to really cut out, and we're not going to do that this week. So we need more volume here, greater than that volume there. We'll see. That'll be where we're expecting it to go, though. So if we can get above that level before the point of control moves down there, then, like magic, yay, we made it above the point of control. Not because we moved through it, but because we got above that level before it moved. Got the 5x5 here, 5-day, 5-minute volume profile in green, TPO in blue. Yesterday gave us a point of control to the upside. We can take this level off. We'll just move it over there. Keep that. Take this one off. Since we hit that level yesterday, we actually hit it on Friday too. Did we not go through this one yesterday? This one off. There we go. So a move to the upside, 53.08. The point of control that we're going to have to deal with. And 52.29 is the level we're going to have to deal with. We already had 53.08. That's the point of control that I'd already marked out. And for today, we've already built a lot of volume up here as a resistance area. It's also where we spent the greatest amount of time, so that makes sense. We stayed there all night long. We built out a lot of volume. This is a really good example of a narrow IB and then breaking out of that narrow IB, that narrow range. If we get something like that and it lasts all the way into the RTH, that makes for a fantastic trading opportunity. All you got to do is break that zone. Of course, if you were awake for the kill zone move, this move between 2 and 4 this morning, then you got to take advantage of that. Not me, I was sleeping. All right, so we got the weekly expected move, the doji that we'd already talked about. Right now, we're holding within the week's range, just like we're supposed to. We can mark out, the half back from yesterday, which we've already discussed. That 50% mark is worth keeping your eye on. 52.86. Otherwise, we got the weekly low, 52.38, and the weekly high, 53.60, basically. We are still below the 10-day, cut back down yesterday, and you can see this chop just really highlighting our situation. That's what needs to be resolved. There are periods of time where we chop around the 10, but if you look, it doesn't happen very often, right? Generally, we make the cut and we cross one side or the other and then expand above it or below it by a considerable distance. We don't tend to just hang out chopping at the level for very long, but it does happen. There are periods where we can go back and see entire days and weeks where we just sat there chopping about, stalled, basically. And that really chews traders up, right? Because we're not going anywhere. It looks like we're going somewhere, just like yesterday. It sure looked like we were going somewhere, and then we just turned it all around and came right back up again. Using the 10 for a bias is really helpful until we're chopping through the 10 back and forth. Then it's worthless. That's the 10-day. Step it out to the 10-week. We can see that we're still making that decline back towards the 10-week. That would be a really nice reset to just come on back down, tag that 10, find some structure and some support, and rally out from there. We've seen plenty of examples when we're in a nice, clean, bullish market with grinding higher and higher and higher, where we come back and we tag that 10. That's what we want to see, right? Price rising through that 10, bouncing on it. And that's what we were having up here with these pullbacks. And a market that went from 4,000 to 4,500 and then close to 5,000 in that move. You can see every time it bounced and rallied, it was coming up less and less. Its distance from the 10 was reducing because it was getting slower and slower and slower and slower. So many ways to use that indicator. Love that thing. So let's make this reset. We're still more than 0.75% from the 10-week. That's not much of a move. So we could just go on down there, get that done, get a nice reset, and continue this move. The problem is, let's just go ahead and put this on the daily, get rid of everything. The problem is a phrase called pure price, and it really doesn't matter if you're an indicator person or, if you're just price person, or maybe you want to do both. When is this trend no longer in trend? That's really the full thing, right? So if you're using OCR, then every single candle can be used. You don't need entire series of candles to perform this sort of analysis. So let's just start with OCR. After setting this high and having this equal low, we ended up with this outsized bar. So, new highs, but new lows and a lower close. So that's one. Then a lower high and a lower low and a lower high. 2 lower highs, 2 lower lows. That's the full set. You need 2 of each. 2 lower highs, 2 lower lows, and that is a trend. That's all it takes. We can also just use some generic trend line tactics to where we can take the last swing high and the last swing low. There's our trend. Of course, we can take to the close from the open. There's our trend. Got an R line level here called regression line. Take it from the peak. Just notice I'm all the way down here with my mouse. It'll do its work. You don't have to do anything else. Just snap it. There's our trend. Now that all of that is OCR, one candle reversal OCR. But if we back up and think about this trend from this move that we had and the pullback and now to this point. Sure, we've set that higher high, but we didn't keep it. We didn't really even close up there. So that's more of a rejection than it is a continuation. Now we're building out this topping pattern and we've pulled back. So sure, we've got our low here, higher low. We built a high and then we had a series of highs. So 2 higher highs, 2 higher lows. This is trend without using OCR. That is trend. It is still in trend. The trend is stalled out, if you want to use that phrase, but it is still in trend. And if we were to measure this entire thing, put something like a 786 on there. We cut below that 786, which I don't like, but we did get back above that 786. And the textbooks would tell you to use something like a 618. And we didn't get below that 618. So this trend technically is still valid, but it's a trend in risk or a trend in danger. We could have used moving averages for all of that, and we can just say, well, as long as it's above the 10-week, then the trend is still intact. But now we've set this low. Therein lies the rub. That's now a line in the sand that we need to keep. Because what we don't want is a market that runs up, sets a low, fails to set a new high or an equal high, and then falls down and breaks that low that we've set. Well, okay, we've got the low set. If we fail to set an equal high or a new high, and instead we come down and we break that low, then we've got a trend to the downside. Without using OCR, we've got a trend to the downside. So 5,200 is now a very critical level, line in the sand. It needs to stick. If you're not using futures and instead you want to use SPY, it looks the same. So even though the numbers that we're talking about don't match, the pattern is still there. It's 518. It's this wick. That low has to hold. I'd call it 520, right? Just to try to stay on the round number as much as possible. We need to stay above 520, not close below it. Adam Grimes talks about that pure price method in his book, The Art and Science of Technical Analysis. If you want to read more into it, it's an old book and I've got it in PDF. So if you want it, just hit me up. I'll share it. I share it all the time. Like I said, it's an old book, but I found it to be a great book to read. A lot of my trading style matches that book. Unfortunately, I came up with it on my own and then I read the book. I wish I'd have done that the other way around. It has saved me a lot of work. Same thing with the Qs. Just call it 445. But now that we've got this low set, that low needs to stick, needs to keep. Don't want to cut that low. And the Qs, the SPY, the ES, we have to make an equal high or a new high. If we don't, if we end up, pulling back here, setting a lower high, then the market's very likely going to come back and retest that. You can see, 100 different examples of this in the past where we set a low, we ran up, we failed to set an equal high, and we just pulled back some, but continued the move. So we can survive a pullback without getting that equal high. The test will be if this gets broken. So if we pull back and we set a lower high here, then it's game on. Once this pivot is made, we're at a bit of a pinch. This low or that high. Go back and find every example where the pullback rallied and made it and where the pullback didn't make it. Like back here, where we set the low, failed to set an equal high, broke that low, set another lower high, broke that low, right? Just keep in mind, we're not looking for a bear market. We're not looking, 2023 and dropping down through major levels and really expanding to the downside. That's not the kind of environment we're in. But we could be bearish enough to see 5,100, 5,000, even 4,900, and it still wouldn't be, quote, a bear market. Not like that entire year, right? And even in that year, it took a lot of analysts until March and April and May, and really the late part of April and into May when we finally broke this low and cut lower, that they finally started to agree that maybe we are in a bear market. It took them quite a long time. They were using antiquated things like distance from the highs, 10% distance from the high, 20%. Just read price. All right, I already mentioned it, but financials are down this morning. Gold miners are down, emerging markets, which is basically China, uranium, semiconductors, energy, more financials, but this one focused more on the banks themselves. Energy, metals and mining, financials, semiconductors. Those two, they're not at that 0.5% that I like to use, but they're close. So we'll count it. Looking at what's up this morning, China ADRs, which is odd because we've seen emerging markets were down. Emerging markets is basically China, but this KWeb is China internet stocks. So, it's a niche, just like XLK. A lot of times we'll say, well, tech is the market, but technically it's not, right? So XLK is not the S&P. And the KWeb, as much as we refer to it as China, it's not really the whole China market, right? It's just the internet ETF of China. So China tech. MCHI is a better representation of China, and that's up, but emerging markets are down. And that's probably India. They're now arguing about how close this race is, and it might not be such a foregone conclusion as they thought it was yesterday. And India is down quite a bit. I didn't think that India's weighting in emerging markets was big enough to cause that sort of a pullback, but obviously it is, or it would be up this morning with MCHI and KWeb. So that's why we keep all three of those in there, right? Generally, they'd all be agreeing and China would be up or China would be down, but very likely India took emerging markets down. I love how they think that the third largest economy is an emerging market or China is an emerging market. Come on. Whatever. and nat gas. And we don't want a rally based on nat gas and China stock. We need a rally better than that. So looking for, any sort of move to the upside today, we're going to need something else. Consumer discretionary, maybe get those financials turned around, some mega market cap tech names, the Mag 7, something like that. Nat gas has got a lot of work to do, and on the ETF, or, this UNG, it doesn't look that bad, but if you were following the spot XNG, out here on the daily and the weekly, it's got a lot of work to do. This is still just a beat down bottom fishing trash play. But, if you're day trading and looking for something to play, then, maybe it's better than nothing. I don't like it. We're trying to get a little love in bonds. Keep your eye on this one. We might actually rally up, get through that trend line. TLT in 93 would be nice. We're at 92 flat right now. It's a really nice continuation from yesterday. You see a really explosive move. A kind of a upward sloping bull flag. If we just think about yesterday, right? There's the pull, there's the flag, but it just kept right on grinding higher and higher and higher. Now with this outsized bar, I would do my analysis on that bar. If you're looking to day trade or put on a short-term trade with TLT, use this bar right here, this 8 a.m. bar. Quad levels above and below, split the midpoint, and bullish above, bearish below. It's pretty easy. That's a lot of resistance. I just updated the levels. You can see 3 lines here, 3 trend lines. Now, they're just trend lines, and they're angled trend lines, no less. So, they don't have weight. The market doesn't see those lines. But we also have this sell zone here where we popped up into a bunch of sellers and we took a beat down, coming right back up into that same zone. Could look at it from all the way back here in April, as these surprised trapped traders got dumped. We don't know if we've absorbed all of this liquidity or not. So when we get into 92.25 or 92.50, we still have to be concerned about those sellers right there. And that kind of lines up, with all of these lines here. Got a lot of reasons to suspect that getting above 92.5 or even just getting to 93 is going to be difficult in bonds. The concern, of course, is if we see bonds go down, then we might see the TNX go up, yields go up. So it's pretty simple from the idea of what's up. Basically nothing. Some China names. That everything else is down. There is a little bit of a concept worth discussing when it comes to getting a fade in the S&P. It's not like getting a fade in, an equity name, because those tend to take a significant beat down and change their price a lot. When it comes to the indexes, we tend to think about the range. Everything is like that standard deviation, especially the S&P. So we always want to think of it from this bell curve idea, right? If you've ever seen like a bell curve, you got your one standard deviation, and like there's 60% of everything happening in that one spot. Now flip that on its side, and you've got your 70% zone, 60% zone, that standard deviation. If the markets like the ES move that way, and we want to think about a sell-off in the markets, We see this a lot where we'll set a high. And instead of just dropping it like a stone really fast, they'll have, an overnight move where we drop really far and then we'll rally back up, not as high as where we closed, but we'll rally back up, right? So we'll drop real hard in the overnight, get into RTH, we rally back up and we'll close just a little lower than the previous day's close. And that lowered the market a little bit. Then we'll do the same thing again, drop really hard, rally back up, just staying lower than the other one. We see that, right? Like there's the close, there's the close, there's these two really close together. That's what we're kind of looking for, right? A lot of this, especially at the beginning, where we might close low, but we're really not changing much in the market. But it is going lower. We see that tactic a lot when they're just trying to shift everything gently to the downside without big, significant, sweeping moves to the downside. Think about the kind of moves that we've seen in the last few weeks. 2 weeks. We've had some pretty good sized swing days and still haven't really changed much. So this move down today, just like yesterday, just like Friday, could be just a flip. We've got some examples back here, that really big sell-off, and we rallied all the way back up, closed at the high, then we dojied, then we got that spinning candle, and then down we went again. Reset the whole thing all over again, right? I would focus on this candle right there. There's our big day. There's our doji day. There's our spinning candle. Big day, doji day. All this has to do is rally back up, close above the open to make it look like this. Yeah, maybe. Everybody, be careful, be safe, have a good day.